Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, also known as Mr. Valuation. And as that moniker is so important to me personally, it's also extremely relevant to this particular video. Because what I'm going to talk about today is what I consider to be one of the most important principles of true value investing, and that's the margin of safety. You know, legendary investor and teacher to some of the greatest investors ever walked the planet, also known as the father of value investing, Ben Graham, so famously introduced this concept of margin of safety. And it's such a critically important concept. And when we've been dealing with a bull market like we have for the last, since the beginning of 2009, the spring of 2009, we've had this long running bull market. The concept of margin of safety is very, very easily cast aside by people. It's either forgotten or simply overlooked, or people just simply argue that it really doesn't matter anymore. And those are really troubling issues to me, because valuation always matters, and it matters a lot, as I'm often fond of saying. But I also want to point out that there's no better way to protect money than to invest with a margin of safety, in my opinion. And that's why I consider it to be perhaps the most sacred principle of value investing at all. Now, it's very, very difficult, near impossible, frankly, to find companies with good margins of safety in today's overheated market. And I'll talk a little bit about that as I get into the video. But as I've always said, if you're willing to look and willing to look hard enough and carefully enough, in every market, whether it's a bull or bear market, you'll be able to find good value if you're willing to look. It's easier in a bear market to find value than it is in a bull market, and vice versa. But it's always there. It's a market of stocks, not a stock market. So let's go ahead and get into the video. What I'm going to do here is present for you about 15 S&P 500 stocks that have a margin of safety, that I believe contain a margin of safety too, some more than others. Now, this is far from a comprehensive list. There are a lot of other names I could have had here. I just picked about as many as I could cover in one video. And having said that, I'm going to cover them strictly from the perspective of earnings and things like dividends and earnings yields, to just point out that, these stocks do have a margin of safety. And what a margin of safety does for you, and I'll be illustrating that, over and over again throughout this video, is it reduces your risk while simultaneously increasing your rate of return. It provides what I call natural leverage, because regardless of how fast the company's growing, if the stock price value is significantly below its intrinsic value, then inevitably the stock will revert to the mean and move back into alignment with intrinsic value. There's an argument that the market is efficient. I argue that it's not efficient, but I will agree that it's always seeking efficiency. That's why valuation is so important, because inevitably stocks will move into alignment with their intrinsic value, which is generated by fundamentals, primarily the amount of cash or earnings that it generates on its shareholders' behalf. Now, when you invest with a margin of safety, you get expanded rates of return at reduced risk, and that's contra to what the standard rules of investing are, that you can only get higher returns if you're willing to take on more risk. And the beauty of the margin of safety, it turns that concept, that notion, on its head. You actually take significantly less risk while simultaneously enhancing your rates of return. And in contrast, there's a lot of people that are willing to capitulate on this idea and are willing to pay these high valuations and come up with justifications that's inflation or low interest rates or whatever are justifying these current high valuations. It always comes down to how much money the company is generating on your behalf. What is the return on your investment that you're getting when you invest in these things? So I've put together 15 stocks here, and again, I could have given you a lot more, that have a margin of safety. And what you're going to see here is they really come from a lot of different industries and a lot of sub-industries. So let me go ahead and add the sub-industries here, and you'll see that there's, I've got food retail, integrated telecommunications and Verizon. I've got healthcare, biotech, tobacco and Altria, life and health insurance and Aflac, pharmaceuticals, asset management. Notice there's a lot of healthcare in here, and something that I didn't include, which I also could have included, was a lot of regional banks, which I didn't cover. It might be something for another video. But I've listed them here in order of lowest estimated total annual rate of return to highest. And as you can see, when you get down here to Unum, it's got a potential to generate 58% annualized rates of return over the next 2 or 3 years. not because this is such a great company, not because it's growing real fast, but because the stock is so inexpensive. And I want to talk about that as I go through here. Anytime a stock is inexpensive, people are always looking for reasons. And there usually is a reason, but the reason is not always a good reason. In other words, it's not always a justified reason. You know, emotions drive stock prices in the short run. And of course, fear and greed are two of the most powerful emotions that investors have to deal with. And I always say fear is the worst. But fear can cause people to, misappraise the value of stocks dramatically. So let's go through these 15 companies very quickly here. But I want you to get the concept of margin of safety. And I'm going to start with Kroger, which has the lowest estimated rate of return. And as a result, one of the lowest margins of safety of any of the stocks in this group here that I'm going to be showing. Now, as I like to do, I just want to orient everybody to what you're seeing on the graph. The orange line on the graph represents intrinsic value. And in most of these graphs, you're going to see that's going to be represented by a PE ratio of 15. So anywhere the stock price touches this orange line, it's a PE of 15. The blue line is the normal market, the trimmed average market. In this case, that's pretty much the same number. It's 14 versus 15. But what I want you to see about this is, notice how the stock price goes where the earnings of the business go. That's, you're going to see that over and over again throughout this video and this presentation. Now, there are times when price gets well above the earnings line and it reverts to the mean. I do this so often in these videos. There are times when it gets below the orange line, but then eventually reverts to the mean. But this is also an important aspect here too, because keep in mind, value is not just about earnings yield and not just about the margin of safety based on a low valuation. It's also about what the future growth is going to be. And there has to be some growth to really justify low valuations. I want to make that point. So here's a case where even if you bought the stock with a good margin of safety, and margin of safety is simply saying that, its stock is trading below its intrinsic value so that it's already so low that most of the risk is taken out of the stock. But then you also got to be careful for dropping fundamentals, for deteriorating fundamentals. But nevertheless, even in this case, if you'd have bought the stock when it was inexpensive here, eventually you started doing pretty well because the fundamentals turned around. Kroger is like most grocery stores, a low margin business. But also you see the principles of high valuation apply here, where the stock gets overvalued, where people get irrationally exuberant, and then we see a crash. And you normally see the market, overextend itself either on the upside or the low side. And Kroger's a classic example. But then we had a reversion to the mean. It got low again, reversion to the mean, low again. And now we're moving back to the reversion of the mean. But the key point is that Kroger is only expected to actually have negative growth going forward. They're expected to grow 2 or 3% long term, actually 7.5% long term, But the near-term growth on Kroger, and this is the point, I'm going to combine the near-term estimates with the trend line, is expected to be weak. So that gives it a little bit of a justification for why the price is low. But once this stock starts growing again, and if it reverts to the mean and moves back into alignment with a 15 PE, you can buy it today at a PE of 10.9. We'll call it 11 times earnings, a dividend yield of 2.15%. And this is an investment class, triple B rated investment, if you will, company. It's obviously a grocery chain. The point is, if the stock moves back to this 15 PE, you could make 30% type rates of return this year, annualized, but going out a year and a half, double-digit rates of return, and even all the way out to the end here, about 9% or close to double-digit rates of return. But that's more than what the growth is expected to be, and that's the point I want to make. That's what I call natural leverage. Now, Kroger doesn't have a huge margin of safety today, but it does have a relatively modest margin of safety. I think that's, important, because the more you can find a margin of safety, the better your long-term rates of return are going to be given any company, and the less risk you're taking to generate those returns. Now, the next company I want to cover is Aflac, and Aflac has a relatively small margin of safety, but this is something that's true about financials, and I want you to be aware of this. Prior to the Great Recession, financials like Aflac traded at 15, or you can see here, there's lots of times where it traded at 18 to 20 times earnings. As I run my mouse along the price line, it was actually above the 15 line. But since the Great Recession, which was primarily a function of, lax lending practices, and, it was really a financially instituted Great Recession, since that time, I want you to note that the valuation has been much, much lower. So if I shorten the time frame and get rid of these higher valuations, you'll see that, more recently, financials have traded somewhere around 10 times earnings. You could say, 8 to 12, 9 to 11, whatever. The point is, none of these things are perfectly precise, but they are within a reasonable range. But a 10 multiple is what the blue line here is. So the reason I brought this, I don't think on that basis that Aflac has a margin of safety based on how the market's been valuing it since the financial debacle. I would argue that it still has a margin of safety, assuming that someday it might move back into these more normal valuations that are awarded to most companies with similar, characteristics of Aflac. But in July of 2020, I did write an article and posted it on the website Dividend Kings that I'm one of the co-founders of. And I pointed out that Aflac, that I liked it, not because it was growing so fast, because if I look at this stock post-recession, you'll see that it's been about a 6 or 7% grower. Okay, so I didn't like it because it had this great growth potential. What I liked was it had this tremendous margin of safety. You could buy it at almost half of what I would consider to be a fair value PE of 15. It was trading at 7.5 times earnings. Today it trades at 10.5 times earnings and offers a 2.48% dividend yield and a fabulous earnings yield of 9.51%. But that's assuming it gets back up, to a 15 PE is where you could really make money. But the point is, I recommended the stock here as a margin of safety example. And since that time, we've had this 60% annualized rate of return in just a little bit less than a year. It's actually a 49.5% pure, capital appreciation plus dividend income gave us a 52.5%. But the point is, the margin of safety allowed you to earn that rate of return despite the fact that the company was only growing at about 5 or 6%. Now, I don't think Aflac has that margin of safety as much today as it did when I wrote this article, but it still has a great margin of safety. And the point that I want to illustrate with this example is the margin of safety gives you natural leverage. It allows you to get an expansion of PE ratio. The PE ratio went from 7.5 to 10.5, which is a lot, but not, up to the 15 that it could have been. If this stock were to go back to that 15 PE ratio that I talk about, the rate of return would have been over 100% in less than a year, or 76%. But the point is, that's what the margin of safety does for you. And even though this market's inflated, there are still plenty of stocks that are giving you a margin of safety. Verizon's a good example. Not a real fast grower. Long-term growth's only been 2.5%. If I shorten this to the last 15 years or so, it's been averaging about 5%. If I go to forecasting and look at the trend line growth, it's expected to be about 3%. So there's not a lot of growth here, but there is some, and I want to emphasize there's some growth. What makes this an attractive investment is the notion that if I look at the graph historically again, I do want you to note this is a 13.8 PE ratio because the growth is so low. So this is only 13 times earnings. And right now, the stock is only trading at 11 times earnings. So if it gets back to that 13 times earnings, or even better yet, up to a 15 or 14 times earnings, which is what this forecasting graph is suggesting based on a little faster growth rate, the rates of return of investing in Verizon today could be double digit, 15% plus rates of return over the next 2.5 years, over 20% rates of return for the next year and a half. And it's the leverage. It's the leverage of the stock going from a PE ratio currently of 11 to a PE ratio of 14, and then adding in a little bit of growth at about a 4.5% dividend. Because dividend is another attribute of valuation that I want to go ahead and bring into the equation now. And the key is you want to invest in these stocks when their dividend yields are on the high side of normal. Okay, here you see the dividend yield was 5.64% when Verizon was very inexpensive. Here you see the dividend yield was 4.2% when the stock was a little more expensive. Today we've got 4.45%, and it ended last year with a dividend yield of 4.23. So we're up a little bit, which means the valuation's a little better. You can see the stock has gone down just a little bit. But what makes Verizon attractive now is not high growth, a good dividend yield, and a really nice margin of safety. AbbVie is one that I've featured many times before. This was a spinoff from Abbott Labs. You can see this stock is clearly traded at a 15 multiple. If we buy it today at a multiple under 10, a blended PE of 9.97, earnings yield of over 10%, dividend yield of 4.5%. If I look at this stock, even from a subdued lower normal multiple of 12 times earnings for the next 2 years, I'm making 30% plus rates of return. Even with the loss of Humira, their flagship product, analysts are expecting a slight drop in earnings because they do have other products in the pipeline. I would still have double-digit returns. I get to 15 PE and my numbers look a whole lot better. And the point is, that's also an aspect of the margin of safety. I've kind of got a low case and a moderate case here. Okay, but if I wanted to look at it from a standpoint of a high case, there are times when this stock is traded at a 19 or 20 multiple as well. So I could also run my calculations looking at a 19 multiple, or which is this first blue line here, which makes these rates of return staggering. I've got low risk. I've got a good quality company because I've got low valuation, and that's what makes this stock attractive. Altria is a classic example. You can see it's been a 15 times earnings company, got overpriced, fell dramatically. It's now undervalued. There's a nice margin of safety, whether you like their product or not. You've got the ability to make staggering rates of returns owning Philip Morris. I still call it Philip Morris. The MO stands for Morris, but it's now called Altria. As you know, they've spun off, Philip Morris International, et cetera. But the point is, very inexpensive stock that I can buy with a solid margin of safety. Allstate is another example of an insurance company. And as you're looking at these graphs, notice how when they really had a superb margin of safety, how good they've done. You get this reversion to the mean happening with these stocks. Allstate, provides us a tremendous margin of safety, even with an expectation of a negative earnings growth in 2022. If I was researching this stock further, I would want to know why the analysts expect that to happen, by the way. Bristol Myers has just gotten ridiculously cheap. This stock has always traded at 15 to even 18 or 19 multiples. It got up into multiples in the 30s, just as early as 2016. You could buy it today with a PE of under 10, a dividend yield of almost 3%, an earnings yield of 10%, and a terrific margin of safety. This company has the ability to generate staggering rates of return going out over the next 3 to 5 years, assuming all it has to do is move back to a 15 PE ratio, which the stock has traded at or higher. And notice this is what's really befuddling here. The stock's growth rate is actually accelerated here significantly above its historical norms. Its long-term growth rate is expected to only be about 7%, but that gives you the ability just at a 15 PE, natural leverage, a little PE expansion, to have these tremendous rates of return in an extremely high-quality pharmaceutical company. CVS Health, here's one that, you can see the 15 multiple, the high valuation. It's had a margin of safety for years, and that's another thing. Don't expect instant gratification, but I believe it's simply amazing opportunity to be able to buy a stock of this quality at these type of valuations on the idea that it won't be necessarily that long where these stocks will trade at a 15 PE again. And if you're a patient investor, you could be making 15, 20, 25% annualized rates of return investing in a high quality company like CVS. Now, part of their problem is they have elected to freeze their dividend for a while, but they're still yielding over 2.4%. Very attractive. Bank of New York had a great margin of safety about 6 months ago. It's one of the reasons I bothered to show it. It's normally a 15 multiple company, currently trading at about 13 times earnings, but clearly looks like it's moving back to this 15 multiple, which would give us the ability to make these very, very strong rates of return, 20% plus rates of return, even though the business is only expected to grow at 12%. That's the beauty of investing with a margin of safety. I did throw Discovery in here because I don't know exactly what's going on with this company. It's something I'd be interested in knowing, but this is more of a growth stock, no dividend here. But you can see how the margin of safety came into play. Something is causing their stock price to drop. Some of you may know what the reason is. I haven't followed this company. It's gotten inexpensive again. So once again, just looking at a normal 15 PE ratio, and you can see this stock has traded at much higher valuations an awful lot of the time over its history. You've got, again, a really strong 30%, 25%, rates of return potential. McKesson, extremely high quality healthcare distributor. These companies are still suffering from the opioid crisis, but you can see the market always valued this at a 15 PE. The growth is actually staying very similar. Forecast growth for this company is over 10% for the next couple of years. Longer term, it's expected to grow at 10.5%. And yet you can buy the stock at a 10.7 PE with a relatively low dividend yield because this company doesn't pay, a lot of dividend. That's not its forte, but you can see the payout ratio is single digit, so it's very low. But this is a marvelous time to be buying this stock because your long-term total rates of return here could be staggering investing in McKesson at these prices. Principal Financial Group's another example where you had a tremendous margin of safety in March of 2020, coming out of COVID, but then you can see the stock has reverted to the mean. So I wanted to show that, this is another case of a stock that traded at 15 times earnings. More recently, it's been about a 10 multiple, 10.7 multiple. So it would be a little pricey on that basis, but you're getting almost a 4% yield, an A- rated company with very low debt. I believe this has a margin of safety. I do believe that one day you'll see Principal back at a 15 PE ratio. And, same for Prudential, same story, very high quality company, A-rated, very low debt. You can buy it at a significant discount to its, potential. It's got decent growth expected going forward this year, slowed down a little bit after that. But, because you can buy it so cheap, it gives you the potential to make these just staggering rates of return, just assuming the price reverts to a 15 PE. Very similar story with Manulife, another great example. And then finally, Unum, which is probably one of the cheapest stocks in the market, triple B rated, 24% debt. There are some issues with some of these companies, and COVID, was a big issue that scared a lot of investors. But these companies are continuing to put out good numbers. Their fundamentals continue to look very healthy, and you can make these staggering rates of return investing in these stocks. So, these are just examples of great businesses that you can buy with a margin of safety. Now, when you get into a market like we have today, where you have these extremely high quality companies, some of the best in the world, and certainly one of the top companies in the world would be Microsoft, and I've talked about it, quite a bit in the past. I do want you to see it from a couple of perspectives. The market has been valuing it at a high valuation. Its growth rate has actually accelerated a little bit, but it's always been a double-digit grower, but it's normally been a 15 or lower. There wasn't too long ago you could buy it at a 10 multiple. The point is, at this high valuation, your dividend yield is only 0.8%. That's one of the lowest dividend yields this stock has ever traded at. That should tell you something. The forecast growth rate is about 15%. That's awesome growth for a $2 trillion market cap business. And the longer term 3 to 5 year growth is still expected to be 12%, but it doesn't justify these high valuations. This has gone on for several years now, but in the long run, these kind of things can be very dangerous, and they could end badly very quickly. In my view, I'd much rather buy a very high quality company that I could buy like McKesson with a great margin of safety that gives me similar growth potential, but I can buy the stock a lot cheaper and have a lot less risk in earning the returns that I want. Margin of safety is one of the most sacred principles of value investing. Anyway, this has been Chuck Harvell saying thanks for watching. Remember, I only covered a few examples here. There are a lot more I could show you. There's all kinds of healthcare companies, all kinds of financials that are trading with a margin of safety, but there's also, as I showed you with this particular presentation, there's also companies in other sectors that you can buy that, do give you a margin of safety or have a low valuation. You just have to be willing to look. Thanks for watching. If you liked the video, give me a thumbs up and a like, ring the bell, subscribe to the channel. We appreciate y'all. Thanks for watching. Talk to you again real soon.